Australia's $12.6 trillion property market just did something it hasn't done in years. It stalled. Sydney and Melbourne prices are falling. Auctions are missing their targets, and economists are split on what happens next. If you own a home, are thinking about buying one, or you're just renting and praying, this video is for you. Let's set the scene. For years, Australian property only moved one way, up. Prices smashed records in Sydney, Melbourne, Brisbane, Perth. Buyers lined up. Auctions went wild. FOMO ruled. But in May 2026, something changed. The National Home Value Index posted zero growth, flat, the weakest reading in over a year. Annual growth is still positive, but it's sliding, down to 8.8%, from a peak of 10% back in February. So the big question everyone's asking, is this the beginning of a real correction, or just a breather? Stick around, because the answer depends on where you live. Three forces are hitting the market at once. Force 1, interest rates. The RBA has been hiking. That makes borrowing more expensive. Fewer people can afford the same loan they could a year ago. Force 2, tax changes. The federal budget brought reforms to negative gearing and capital gains tax. That shook investor confidence almost overnight. Force 3, consumer sentiment. Confidence has dropped sharply. Global uncertainty isn't helping. When people feel nervous about the economy, they don't rush into six-figure decisions. Put those three together, and you get what we're seeing right now. Clearance rates falling, sales slowing, and price growth grinding to a halt. But here's what almost nobody's talking about. This isn't one housing market cooling down. It's several markets moving in completely different directions at the same time. And that changes everything about how you should think about this. Let's break it down, city by city. Sydney and Melbourne are leading the slowdown. Prices in both cities have been easing for months. In the top end of these markets, values have now fallen for 5 straight months. These two cities are the most sensitive to interest rates, which is exactly why they're feeling it first and hardest. Meanwhile, in the mid-sized capitals, it's a different story. Brisbane, Adelaide, Perth, all three kept growing through the same period Sydney and Melbourne started shrinking. Why? Lower price points, stronger population growth, and buyers chasing affordability, moving their search away from the two most expensive cities in the country. Economists expect that gap to close eventually, with Adelaide, Brisbane, and Perth likely to lose momentum too as 2027 approaches. But for now, if you're watching national headlines and assuming your city is cooling, check again. The averages are hiding a very uneven picture. Now here's the twist that catches most people off guard. While the buying market slows down, the rental market is doing the exact opposite. And if you're a renter, this next part matters more than anything else in this video. While home values flatten out, rents are still climbing fast. Vacancy rates nationally have fallen to just 1.5%. That's a record low. Annual rental growth has accelerated to 5.9%, the fastest pace in well over a year. That means renters are getting squeezed from both sides. Fewer available properties, faster rising rents. Many households are now spending close to a third of their income just on housing. Here's the strange part. Falling prices and rising rents are actually pushing rental yields higher for property investors, which means even as buyer demand drops, the investment case for holding rental property is getting stronger on paper. So while the headlines scream, housing market cooling, a huge chunk of the country is experiencing the opposite problem, a rental market that's tighter than ever. So where does that leave prices heading into the rest of 2026? The major banks have already started changing their forecasts, and the new numbers might surprise you. Major bank economists have downgraded their outlook more than once this year. Some are now forecasting capital city prices to grow by less than 3% for all of 2026, a big step down from earlier predictions closer to 5%. Others are even more cautious, expecting national dwelling prices to be roughly flat for the year. The consistent theme across almost every forecast, higher rates, tighter lending, and softer sentiment, are expected to keep weighing on the market through the rest of 2026, with Sydney and Melbourne underperforming the rest of the country. Nobody serious is forecasting a crash, but almost everybody agrees. The runaway growth of the last few years is over, at least for now. So what do you actually do with this information? If you're a buyer, softer conditions in Sydney and Melbourne mean less competition and more room to negotiate for the first time in years. If you're an investor, rental yields are improving, even as capital growth slows, which changes the math on cash flow versus growth. If you're a renter, don't expect relief. With vacancy this tight, rents are likely to keep climbing regardless of what home prices do. Three very different situations, same market. Let's bring it all together. The national market has stalled. Sydney and Melbourne are leading the slowdown. Brisbane, Adelaide, and Perth are still holding up, for now. Rents are surging even as prices flatten. And most banks expect modest, not dramatic, price movement through the rest of 2026. This isn't one story. It's 4 or 5 stories happening at once, depending on where you live. If this helped you make sense of what's actually happening in the property market, hit subscribe. I break down what's really going on with the Australian economy every week, without the hype. And drop a comment. Are you seeing this slowdown where you live? Or is your market still running hot? See you in the next one.